Hey guys, OPSEC here, and today we're going to be breaking down technical analysis and liquidity. So we'll begin with what is liquidity. So liquidity is pretty much money, okay? Let me elaborate, right? So let's just say you have a portfolio, and your portfolio consists of two houses and a car. Now, two houses and a car is not very liquid. You can't buy many things with two houses and a car. But you could sell two houses and a car for money, and then with the money, you can buy whatever you want. Why? Because money is the most liquid asset. Liquid is something that moves fast. That's why money is the most liquid asset. So when you're liquidating your portfolio, you're actually just exchanging it for cash. Okay, so when you're selling your house for cash, then you're liquidating. Okay, same with long and short positions. When you sell a long position or when you sell a short position for cash, exchanging for cash, then you're liquidating. That liquidations happen either at your stop loss or at your take profit. So when you enter a long or a short position, then this up here would be your take profit for a long position, and this down here would be a stop loss. Now, if I were to enter a long down here, and I had my take profit right up there, right now I would be liquidated. Or if I entered a long up there and had my stop down here, right now I would be liquidated. Okay, so why does this matter, right? I'll tell you why this matters. Because now, after the last video, in the last video I taught you how retail thinks, how the masses think. So now, if we can understand how these guys operate, where they set their take profits and their stop loss, we could understand where many people are buying and when many people are selling. And now, how is this helpful, you might wonder, right? How is this helpful? Well, if you were a large institution or a bank or whatever, and you want to participate in the movement of this market with billions and billions and billions of dollars, then you would have to think who's buying from you wherever you sell, and you have to think who's selling to you wherever you buy. Otherwise, you're gonna move price in a way where you might not want to move it, right? Because if they just randomly decide to sell here a lot, it may move price down. Like they may have to sell at a way lower price. Like instead of up here, maybe down here. But if they do it in the right manner, they could sell it at the exact place they want to. If they could somehow manipulate people to buy at this price. And how can they do that, you may wonder? Well, remember in the first lesson when I taught you about longs and shorts? Pretty much when you are in a short and you want to close your short, you have to open a long. Okay? That's what we taught in the last video. I mean in the first video. So if when you're in a short, if when you close a short, you open a long, you're actually just buying when you close your short. So this means that when people close their shorts, they are buying. Okay? So let's just say a lot of people shorted over here. Let's just say they aimed for over here and they had their stop loss over here. Okay? Now they would get stopped out. So a lot of people would be buying at this price. So now, if the banks wanted to, they could have set passive order flow limits above these highs to buy out those stop losses. Let me explain to you what passive order flow is in case you don't know. Okay, so this goes into the market making series that I was going to do, but let's do it here. So market making is pretty much how the books work behind the scenes. Okay, so let me demonstrate to you how it looks like. So it would look like this, right? This is how the books look like, and there's ask on one side and there's bid on the other. I'm not sure if it's on this side or on the other, but whatever. Right, so ask and bid. Bid being buy, ask being sell. Okay. Now, let's just say, let's just draw a hypothetical chart. Okay, so let's just say we have a chart over here. And price is currently at 10, okay? I'll do it with trend lines. Right now, wherever prices, there are equal buyers as there are sellers, okay? So let's just say price is currently at 10, okay? And now let's just say I'm gonna put an ask limit. I want to buy 10, I want to sell 10 contracts at 12. So that's pretty much go short 10 contracts at 12. And I want to buy, and I'm setting a limit to buy 10 contracts at 9, okay? Now, if somebody else now were to market by 10, he would be buying for $2 higher than the price of 10. $2 higher than the price he expected to buy at. Okay? And then price would move to 12. Why? Because I am the nearest seller. Right over here. And now, notice how 10 contracts moved price by 20%. Okay? It moved price by 2. From 10 to 12. Now notice how if you sell here, tell 10 contracts. If I were to sell here 10, now this would be deleted. Now if somebody were to market sell here 10 contracts, this is called active order flow. Price would instantly move down to 9. Now notice how price can move 2 up with 10 contracts and 3 down with 10 contracts, right? With the same amount of volume. How does this work? This is what market making is about. You can move price and it's not dependent on the amount of money if you structure it correctly. Let's just say, here, I'll give you an example. I'll give you areas where there may be a lot of resistance for them to move price, and I'll give you areas where there may not be a lot of resistance. Over here, there was, what is this? That's a bearish structure break. Okay, so when we go under a low like this, that's a bearish structure break, and a lot of people are going to be saying limits all throughout this move. Okay, limits to sell, ask limits. This means if all throughout the premium of this move. Okay, this means if they want to move price through here, they're gonna have to be market buying with large volume. However, above this, they have no resistance. They can move price as much as they want, and there is absolutely no resistance because nobody has sell limits over here until we come across a support and resistance level or something along those lines. Okay, so this is how market making works. So over here, it would cost them a lot of money to move price, but then past it, they can move it for essentially free, essentially nothing. Relative to this, it would like, let's just say it took you $100 billion to move price from here to here. From here to like here, it's gonna cost you like $1 billion max. Okay, that's like the relative cost. Okay. Right, sorry, my shit just crashed, it cut out. Okay, let's continue where we were, okay? So now you understand you can move price wherever you want, and it's not necessarily about money, it's just about how you structure it, okay? So now that we understand this, we also understand that if they want to sell at a particular place, they may structure price in a way that will induce that. So if they have many longs from the price of 10 over here, and they want to take profit them at the price of 12, what they might do is bring price up to 12, then bring it down to 9, and then what do they do by doing this? They are engineering bearish structure. Now, what they will do is they will manipulate price up. How will they do this? They will do this by scattering limits up here. Now, they take in mind that obviously so stop losses are active order flow. Okay, so if I were to short here with a stop loss up here, then that would be active order flow, the stop loss. When that gets hit, that is a market order, right? The stop loss is a market order. Okay, so it's gonna close so if you're shorting, then it's gonna buy from the nearest seller. So if the nearest seller is here, that's called slippage, and it will sell instead of here, it will sell over there. That's called slippage, okay? So what they will do is they will set a lot of limits directly at the sell side, at the buy side liquidity. Right over here, they will set a lot of limits. So I'll just say they set 1,000 contracts at 12, which is right over there. And then when all these stop losses get triggered, they will instantly sell to them. And then by doing so, like, all these stop losses will be buying, and then the banks could sell at that exact price that they wanted to sell. But then you may say, oh, but it cost them money to move price over there because they had to buy out all of the limits over here. So what will they do about that? Well, now they've engineered bullish structure by moving price up. So now when they bring price down, there are going to be people who want to buy over there and they can sell even more to them. Okay, so when they bring price down here, the banks can market sell this time even more and then move price down. And this is how the banks would sell. This is a sell model for the banks. Okay, so the banks manipulate short stops, which is buy side liquidity, and by doing so they're engineering new buyers, and then by doing so they can sell at a high price. So like at the time, this area was considered a high price for them and their ideal price to sell at, and this is how they could sell at a high price. If they just decided to randomly sell, then they would probably get out of their positions at this price instead. But because they were so smart with it and they did this in a way like this, then they could get away with selling it up here and at the expense of other retail traders. Okay, so this is a little bit about market making. Okay, so right, so now let's study areas of liquidity. So let's go into some examples. Let me show you a sell model. Right over here, we manipulate short stops. By doing so, we're engineering buyers, allowing the banks to sell all of their positions over here. Okay, so they closed all of their long positions over here, or they opened, yeah, they closed, yeah, they closed all of their long positions over here. Now they may be buying. Why may they be buying? Because we are at a resistance, right? They may be buying throughout this entire accumulation, and they may be engineering sellers throughout this accumulation. That's why they kept it here so long. And then they move price up. And this time, when they moved price up, it wasn't for the sake of selling to the guys who are buying over here, but it was for the sake of moving it higher. Because past this, remember what I told you guys earlier, past this, they have no resistance. Over here, there's a lot of people selling. So if they want to move price up, it's going to be expensive. But then past it, above here, it's essentially free. Okay? So it's essentially free past this, the point. Okay? Like, it's relatively free. It's not free. I'll tell you, it's not free. That's for sure. But it's relatively to this, it's free. Okay? Let's go into another one. So over here, as you can see, there was a resistance level right over here. Remember what I taught you? Support and resistance, market structure. Those are the forms of liquidity you want to pay attention to. We get above it, so people want to buy. It's a breakout, bullish breakout. Imagine you're seeing it like this over here. You would be bullish over here, based off of retail logic. And then this is an opportunity for them to sell, and then they can sell again to the guys who want to buy over here, and then they bring price down. Okay, let's go into another example. So here is a buy right over here. They formulate a support level, manipulate under it. Here they can buy. Here's a resistance, they can buy more. Then they bring price up above this. And now here's a sell. Here they can sell, and here they can sell more at the support. Also, this is a support dating from 2017, so they can sell even more over there. Okay? So this is how banks and institutions trade, okay? This is how they trade. They enter buys and sells. They enter longs and shorts by stopping out or manipulating retail. That is the only way they can do it, because if you think about it, right, there are four main groups that trade the markets. The four main groups are like this: institutions, banks, algorithms, and retail traders. Now, if we were to split this up to profitable and not profitable, it would look like this. Profitable would be institutions, banks, algorithms. Unprofitable, retail traders, right? So now, for in this game, for someone to win, somebody else has to lose, right? So if all of these guys are winning, who are they making their money from? They can't be making their money from each other if they're all winning. They have to be making their money from the losers, which is the retail traders, right? So if they're all making their money from the retail traders, isn't it logical to think that they might be manipulating the way retail thinks? I mean, let me give you an example, right? So let's just say that you were very, very wealthy. Okay, you had a lot of money and you were looking to make more money. Okay, now imagine this. Okay, some dumb guy who doesn't have much money goes ahead and tells you the sun has just set and I don't think it's gonna rise again. I think it's set and it's gone now. How much you want to bet? You hear this, you know the sun, you know for a fact that the sun is gonna rise tomorrow morning, right? You know it for a fact, okay? You want to bet as much money as you can, but you can only bet as much money as he's willing to bet, right? So what are you gonna do? You're gonna try and manipulate him to bet more money. You're gonna be like, oh, you want to bet this much, you want to bet this much, and would it be crazy to think that you might even go to the extent of bribing the media, bribing scientists, bribing researchers to confirm that the sun is not going to rise tomorrow. So more dumb people like him start thinking that the sun is not going to rise tomorrow, and then more people will bet money against you that the sun won't rise tomorrow, and then you'll make more money, and then you'll essentially make a profit. Like, yeah, you paid the media, they had some expenses, but then all the profits come in, so you made money, right? So if that doesn't sound if that doesn't sound crazy to you, then why should this sound crazy to you? You know what I mean? All of these guys are banking on the loss of these guys, and that's how they make their money. Okay? These guys are pretty much us. They are the average trader who comes into these markets. Also, if you think about it just logically, right? Odds are if you made a lot of money, you know how to make a lot of money and you will continue to make a lot of money, and you're not dumb. You're not dumb enough to lose it easily, right? The retail traders are pretty much the poor guys, and these guys are pretty much the rich guys. So they know what they're doing, and then these guys don't know what they're doing. So we are using this logic to build a method which could help us profitably trade. Okay, that's what we're doing. We're using these guys. We're taking advantage of these guys being unprofitable and these guys being profitable to construct a method, a strategy that works. Okay, how do we do that? Well, we understand how these guys think, and then we know what not to do. Okay, so there's a quote from a guy called Emery Tate. He was a grand chess master. He said, I allow manipulation to understand where my enemy wants me to go, and then I use my mind to break the trap and punish the perpetrator. So that pretty much means you allow manipulation. Pretty much you learn what these guys learn, which is the manipulation, to understand where your enemy, these guys, the profitable guys, want you to go, or what they want you to do. And then you use your mind to break the trap and punish these guys. Okay? So that is what we're going to do. So anyways, now let's get into technical analysis, because that is what you guys need to start learning in order to become a profitable trader. So yeah, anyways, so now technical analysis. Okay, so for technical analysis, there are three main tools. It's going to be the Fibonacci, the trend line, and the rectangle. Those are the three main tools you're going to be using. And then past that, you can also use a path, which are pretty nice. And then text, maybe to explain yourself. Hey, I am OPSEC. And then you can mess around with this. Okay, so now, right, so go ahead and place a trend line and then make it look nice, neat. I like having mine black, 2 pixels. Then go ahead and get yourself a rectangle. You get your rectangle from here. get a rectangle, make it nice, neat, so you can analyze neatly. Then get yourself a Fibonacci tool, and now let's go into the settings of this. So let me apply defaults, right? This is the default drawing template. What you got to do is like this. So you disable the trend line over here. That's what I like to do. And then over here, you disable this, 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 and this. These are the settings you want. And then I like just rounding this up to 7.2 and 7.9. Okay. Those are your settings you want. And then you go use one color, black. And you delete the background. And then remove prices. And then I like changing the labels to the right, okay? And then you have it like this. And that's my template. That's what I use, okay? Now, Fibonacci helps you distinguish what is a premium and what is a discount. I'll give you an example. If we want to look for a premium, then we will measure a bearish move, okay? Because you want to sell at a bearish move. You want to sell at a premium. So, right, so you find a premium of a bearish move, and that's where you want to sell. So you look at it like this. This is retail logic, by the way. But yeah. Then you take your Fibonacci tool from here, and then you want to sell it up there. But yeah, so that's what you want to do. And then for discount, you want to look at a discount of a bullish move, like this. This would be the discount of a bullish move. And we bust through it in this case. And then the premium of another bearish move, which would be like this. Here's the premium. Anything above the 0.5 is the premium. Between the 0.62 and 0.79 is what's called the golden pocket, the optimal trade entry. Okay. Now this area generally is where higher resistance starts. Now that's way more advanced, and I don't want to get into that now. But just look and see how price went up, and then when it got to the 0.62, 0.79, it started consolidating. Okay. Okay. Now that's the Fibonacci done. Text, double click it, and then you can type whatever you want. That's text done. Trend line, just change your settings. Pretty simple, straightforward. You got pixels, like how big you want it to be. Then you got colors, like get yourself some nice colors. That's done. Rectangle, I like fucking around with opacity, and you got the colors. You got a border. If you want to delete it, just change opacity to 0, like this. That's rectangle's done. Path, the way you use a path, you click once, you click again, you click again, you click again, and it will continue. And then when you want to stop, you double click. Okay, that's path done. You can mess around with that as well. Make it 1 pixel, 2 pixels, 4 pixels. I like it at 2 pixels. And then color, and that's path done. Okay, now next thing, long position and a short position. This is how a long and a short position would look like. When you want to enter a trade on your broker, then I like to draw it out on my chart with a position like this. So let's just say I want to enter a long position right over here, as I did. I did long euro right over there, and I close it up there. Anyways, what I would do is I would just draw it on my chart like this. And then I could see, okay, so the risk to award is 9. So if I risk $100 on this, I will make $901 on this. And the stop loss size is 66.2 pips. So now I can start calculating how much size I gotta go in with, and so on. Okay. Anyways, what the homework I'm gonna give you guys for technical analysis is, I want you guys to measure moves. So find bullish and bearish moves. Okay, find bullish moves like this. Right? I'll find bullish moves like this, bearish moves like this. Then measure where the premium and discount is. See if people bought or sold there. Over here you can see people sold. Over here you can see people bought and got stopped out. Over here you can see a support level. Oh, right. Another thing I gotta teach you is horizontal lines, which is Alt H. You can either use Alt H like this, or you can, I'll just go into this menu and you'll find it over here. Then horizontal delay, which is similar except it starts from a place. Then let me also teach you how to snap things onto highs or lows. You pretty much hold control and then notice this magnet. You see the magnet over here. When I click control, when I hold it, it will be like this. So if I hold control now, it's snapping onto this, and now it's only gonna snap if I have something enabled. So if I'm holding control and I don't have anything toggled over here, then it's not gonna snap onto anything. But then when I click a trend line, for example, and I hold control, it's gonna snap onto things. And then I click, and now I can try and put this straight. Or if you are having a hard time getting a flat angle on this, you just hold shift and then it will only go by 45 degrees at a time. And then click again and you'll have a trend line placed. Okay, so that's trend lines complete and all of these rays. And then here you have the measure tool. If you hold shift and you click somewhere and click somewhere else, it will measure how big this move is. Or you can just click that and measure it. Yeah, that's, and then if you want to delete all of your joins, you just right click, remove joins, and it will clean your chart. Okay. Also, something you might enjoy using is the object tree over here. So if you, let's just say I do a bunch of these, I want to put these in a folder together. I will call this stupid people 1. And then I can make it visible or invisible. I can draw something else. I can make these invisible, these stupid people. And then I can make a folder for these. And I can call them smart people. Smart people. And then I can choose if I want to see both the stupid people and the smart people, or if I just want to see the stupid people, or if I just want to see the smart people. Right, and then I can delete them like that. So this is how you do technical analysis. These are the tools. And now you just gotta practice and get intimate with the charts. So yeah, so just analyze bullish and bearish structure. Over here you can see bullish structure, we broke a high, more bullish structure. That is a resistance level. And yeah, well, see you guys. I hope you enjoyed the video. That's your homework. Analyze, get intimate with the charts. You got to start somewhere. Peace.